All right, everybody. I'm here with Steven Strazza from All Star Charts. He is the director of research at All Star Charts. I got a new newsletter coming out soon from Strazza himself. Steve, follow him at Strazza at Twitter. How are you doing, Steven?
I'm good, man. Thanks for having me back.
Of course, it's always fun to have you on, especially even Ian, comes on. It's like I was joking with him the other day that it's like, yeah, I get all these all-star charts guys on all the time because they seem to be identifying with what you guys are doing more than anybody else because you guys are really following, what's the price action. You guys have good research of what's going on, and it's just truthful research. You go out there so much and you see so many different strategies, different ideas, but most of the time, everybody almost has I'm long gold all the time. I'm long commodities all the time. I'm short commodities all the time. I'm short stocks, whatever it is. And they really stick to that. And you guys are always kind of focused on what is the market telling us, and that's trading as opposed to trying to sell a product. And that's why I really like what you guys do.
You know, if you're a good technician, you change your mind a lot.
Mm-hmm.
And changing your mind a lot tends to not be a very popular thing to do with most people, right? Especially from a retail perspective. But if you're dogmatic, then you're just not paying attention to the new data, right? We have new data incoming all day, every day from every different angle. We pay attention to it. We do try and change our minds. And at the end of the day, it's really just we put price so far above everything else. It's okay to have a thesis, right? Like you're talking about perma bulls and perma bears. It's
Mm-hmm.
okay to have a thesis, but have a level where you can say to yourself, all right, if we're above, the financial crisis highs in financials, the market's proving me right, right? My fundamental thesis for financial stocks is probably right if we're above there. If we're not, maybe I'm early or wrong, right? So it can never hurt you.
Absolutely, and I think that's something that you just see so much in finance in general or anything in general, where people really want to stick to the idea. But as a trader, or if you want to do well in the markets, you can't really be stuck on an idea. And it depends on time frame, right? Like yes, if you're on a 100-year time scale and you're going to say stocks are going to go up, sure, if that's your time frame, you're probably right. You're winning. But if you're really looking for what's the analysis month to month, what's the analysis quarter to quarter, you're really going to have to be nimble in that sense and understand that a fake out can tell you something, a breakdown can tell you something, all these things. So that you're basically sitting here, like for example, you're looking at the KRE. This breaks down to this level. What if it retraces and breaks right back up? That tells you something is a vastly different than what you were thinking, 20 minutes ago.
No, I couldn't agree more. I'm a big fan, as you know, of following the tape. Always reading the tape. There's so much information in the intraday action in stocks. At the same time, I was on like a spaces yesterday, talking about how ugly the action was, right? Just yesterday, the way we reversed hard after the FOMC. And they
Yeah.
were asking me for like my technical opinion on what I was seeing. And I was like, it's ugly. It's terrible.
Mhm.
But all of these ugly candlesticks, right? And this intraday sell off, one day never makes a trend. So let's see if we get followed through tomorrow. In a trending market, whether it's an uptrending market or a downtrending market, you tend to see follow through, right? On moves like we had yesterday. In a sideways market, in a messy market, it's not uncommon at all to not get follow through. In other words, you have a big splash lower one day and then futures gap up the next day. That's what we mean by a messy market, right? And markets are fractal. So if the trend is sideways on a primary basis, right, or a intermediate to longer term basis, if we have a sideways trend, sideways 200-day moving average, something like that, when you drill down, right, and look at the fractals on a daily or intraday basis, it's not uncommon to see the market act like a total and complete mess and also be sideways. So I think with yesterday, ugly day, today we're higher. You don't want to make too much of it, but that's the market we're in right now.
Yeah, and for me, I really like I as you know, I trade macro every market basically. And I like the days where the stock market is telling me something and then currencies, some of the commodities, bonds are telling me another story, and that's really was yesterday, which was, oh, well, the bonds, the oil was even up, bonds, oil, platinum, gold, silver, all these things had really great days yesterday. But the stocks went another direction. And most of the time it's Fed day. I understand that the first move that happens after a Fed meeting is never right. It's never ever usually the right way. And even if it is right, it's going to either sell off the next. If it went up yesterday, it'd probably sell off today. You got to kind of wait a couple of days. Like Friday, I really feel like that's when we really know what the market is thinking. If the Fed day is on a Wednesday, and it usually is. So kind of looking at it now and going, well, is this the actual move? Let's see how we close today. That can tell us a lot.
I think you make a good point, right? It's not just daily closing prices that are most important, but weekly.
Mm-hmm.
And there's a reason for that. Like, what are investors willing to take home
Mm-hmm.
over the weekend, right? In really volatile, tumultuous times, you see sell-offs every Friday afternoon because investors don't want to take any exposure home, or they want to take less exposure home, right? I think the way we've been paying attention to, I think gold as a good example of that, keeps closing the week really strong, week in and week out. So that's been an area to watch. But speaking of, the selling pressure and the volatility from yesterday following the Fed, I'm paying attention to not just the follow through today, but what are people going to take home tomorrow, right? How do we end the week, like you said? So totally.
I mean, that's why, as you get to further and further time frames, this is an important part of technical analysis. If you're looking at daily closes and you find that that's powerful, like wait till you start looking at weekly closes, wait till you start looking at monthly closes. Like these things are the most powerful things that we can see in the market. And you brought some great charts today. Let's dive through some of those. I mean, man, it's going through these. There's so much stuff to talk about, and we talked about it this week that there's just so much we could talk about right now because there's so much happening with the Fed days, the banks, and when you're starting out with these bank stocks. So looking here, this is a regional bank ETF, the KRE, and looking at the KRE, like I'm definitely seeing that we had this huge sell off, and it kind of looked like a panic, a little bit more than possibly it really is. But at the same time, it's very real. It is very real sell off. It is not something that I would ever, try to pick a bottom on at the moment. But it looks very interesting comparison. I like the 1 week rate of change. You can see that it's, panic levels, kind of like the financial crisis at the moment or March 2020. What were you seeing in these bank stocks, and why do you think we had such a big, massive day happen? And what exactly are you reading on the tea leaves at the moment?
So disclaimer, this was total chart porn. This was taken intraday, I think Friday, 2 weeks ago, after the Silicon Valley Bank run had occurred that Thursday night.
Mm-hmm.
And intraday at the lows of the week, this was as bad as the financial crisis. And to me, like, that's as bad as it gets, right? Maybe it was only 15 years ago, but it says a lot to get to those levels. On a closing basis, it didn't look like this, but that's not the point, right? There was a massive amount of volatility in the banking sector, and there still is. These charts look terrible. Even the big money center banks that everybody's talking about, they'll be the winners from all this, right?
Mm-hmm.
That gain for them. Those charts look terrible too. Look at Bank of America making new lows right now.
Yep.
JP Morgan, right? So when there's a problem with the banks or the financial sector at large, and this is not just banks, right? This is anybody who takes deposits could potentially be having an issue with this, right? For two reasons. Because if you take a lot of deposits, you had to invest those deposits in a way where your balance sheet management worked and you're able to cover them. And if there's a bank run and you're a deposit-based business, you're at risk here, right? So that's why you're seeing even Schwab get pulled into this and other capital markets firms. It's not just about the regional banks, but especially bad for them. Second largest blow up of all time. I think the bigger point about the banking crisis is that the Fed has to be done, right? Because they're going to cause a credit crunch now. These firms are going to stop lending in large part to weather this storm.
Yeah.
And that's going to be very restrictive from a monetary policy stance. So that's very much going to do the Fed's work for them. I think Powell was sitting in a room somewhere last week, like, yes, we got it. We nailed it. But they're done. I think, honestly, with what happened to the banks over the past few weeks, in a perfect world, they probably would have done nothing yesterday. I think they did 25 to save face because doing nothing might have spooked the market.
I think so as well. Yeah, I really liked what you're thinking here. I do see a very similar picture, and we did end up here. And there was always the famous newsletter writer Richard Russell, and he used to always say, the Fed is stuck between two things. They either have to inflate or die, and that's really like it's spot on for right now. Back when he used to say it, it was kind of like jokingly and like ha ha, but now it's like, yeah, that's where they're at right now. They're either going to do that or they're going to kill themselves at some point and kill off the banks. And so I guess that brings us to a good thing that we can cover next, because I talk about this a lot with people, and it seems like most people don't really grasp it or why it's important. People know of the yield curve, and they know there's an indicator, and they know that you could look at it and say, oh, the yield curve is inverted, and that means that we're going to have a recession or whatever. But why is it important when this happens, and what did this possibly how did this possibly affect the banks?
Yeah, perfect transition from what we were just talking about, right? Like, this is why the banks broke. This is why Silicon Valley Bank broke. This chart right here.
Yes.
Really tells you all you need to know. And it's also why, listen, don't pay attention to, there's been a lot of bad takes all over Twitter lately and in the mainstream media. This is not a one-off. It's not, because this is literally the business that banks are in. They have to take money in and then lend it out at a higher rate. That job becomes very difficult. We could sit here and make fun of Silicon Valley. Their blow up was nuanced, where they had a very concentrated client base, right? Which obviously didn't help, a client base that was already under pressure, talking about tech sector, startup space. So that's what pushed them over. But the issues that they're having, any bank could be, or probably is right now, to varying degrees, right? And what I mean by that is when rates rise too quickly, like they did, really the fastest pace of all time over the past few years, you have credit risk, where as rates rise, the price of the underlying fixed income securities that you own is going to fall tremendously, depending on how much rates rise. If we go from 0 to 5%, like we did, that's going to be very material impact on your balance sheet. A lot of these companies maybe invested the wrong way, entered into, fixed rates. I think Silicon Valley was in 10-year mortgage securities, right? They were fixed at something under 2%. If they started paying 0% on their deposits at first, but then that, rate rose to 3 or 4%, they're underwater. They're losing money. That's not sustainable. You can only do that for so long. And then there's an accounting nuance to it all, where they're held to maturity portfolios. They say, well, we intend to hold these securities until maturity. So they don't mark them down. They don't take losses on them, on their balance sheet. If they did, probably would have seen this problem a quarter ago. Probably would have dealt with this late last year, to be honest, because it was all taking place then also. So they don't mark them down. They don't take losses on them. If and when they do, when the time comes, they have to liquidate. They're selling these things for 60, 70 cents on the dollar, and then they can't cover their deposits. That's how these banks blow up. It's because of spreads, because banks are paying on the short end, paying depositors based on the short end of the curve, and then they're investing that based on the middle, really the middle or the long end of the curve.
Let's define this a little bit more, because for us, we know what that means, but for maybe somebody who's newer watching it, we're talking about the 3-month to 2-year part of the curve being the short end of the curve. That's where we're talking about the banks are getting money from this end. and we're paying it back. They're paying it back at that end, and then we're like the public are paying it back from the longer end. So as this yield inverts and that happens, now the banks are ending up having to pay more money for the short end than we're having to pay for the long end. And then it turns into this situation that's a credit crunch. So why are they going to continue to lend money if they're not making any money on it? You know, that's how we ended up here. And we're not in like a normal inversion of the yield curve. You know, we're in a deep inversion of the yield curve, which means that they're really, you know, not able to make money like they used to. So this is why when you see the rates get pushed to zero, and then the spreads widen, this is why you see bank stocks doing really well around those times, because that's their business. Their business, they are, you know, and you would say it too. And what we're assuming most of the time is that they're lending companies. These are lending companies.
Yes.
That's their main business. That's what we're assuming. So when we see this inversion, that's what we're talking about.
Also, like, you know, you talk about this is a lending issue, right? So why are people sitting back saying, hey, the big banks are fine? They're so diversified, right? Their revenue bases, they're getting money from, you know, everything under the sun. These regional banks might have 75-80% of their revenues comes from just lending, right?
Yes.
So this is the business they're in. They can't stomach what's going on like a Bank of America or a JP Morgan. But the other big point about this chart is simply the volatility, right? So putting aside what the 2-10 spread means for banks, right? The volatility in the bond market for the past 2 weeks is something you really have to pay attention to. When the bond market is moving like this, you really want to be on, you know, kind of high alert, because this chart here, I think, shows it best. It's very uncommon for the bond market to experience this type of volatility, in the stock market not to follow.
Yes.
So, you know, signs of stress always show up first in the bond market. We call it the smart money. We're really paying attention. And when I look through my fixed income chart book these days, you know, we're seeing momentum thrusts in every which direction, moves we haven't seen since the 80s or COVID or the financial crisis. So we, you know, we want to be on really high alert, like I said, for that kind of trickling over or flowing through to other risk assets, particularly stocks.
Yeah, and I definitely, you know, that's a thing that you'll see a lot at market bottoms or market tops, you know, this kind of big rush in volatility, that all of a sudden starts to happen, and you get this dispersion between bond market and stock market volatility. And you know, a lot of people don't really follow things like the move index. You know, it was something that was talked about a lot in the 2008 crisis, and then kind of, you know, people kind of forgot about it. But it's really important, you know, when you have a normal bonds don't usually move that much. You know, they do move, but they're not like crazy moves most of the day. When you have the bond market moving, you know, 2-3% in a day on some days, you know, and a normal day for the bond market becomes 1%. That's pretty big. That's big. You know, we saw that type of move in 2020. That was the last time we kind of saw that type of a move. Now we're kind of seeing it again. And I think there's a couple things to think about it. One is people are obviously spooked. Flooding to safe havens is a thing that absolutely happens. They're absolutely flooding into things like bonds on the long and short end of the curve. Also, the thing that I pay attention to is when the 2-year yield starts to come down, it usually tops out a little bit before the Fed funds rate, almost always. And so we're kind of seeing that yields are starting to smell that this can't go on much longer. You know, yesterday's a great example. You have the 2-year bond yesterday. You know, bond prices are inverse to yields. Bond price started moving up. You know, like, so the yield started moving down, even though the Fed was still raising by 1/4 basis point yesterday. You know, when that sort of thing starts to happen, it's the bond market, which like you just said, Steve just said, it's bullshit. You know, like like I said, it's bullshit. It's starting to smell that it's bullshit, that it can't continue to hike to this crazy point. We're seeing that people are starting to pile into them no matter what, understanding that this has to be closer to an end than a beginning. And so I think that this is an interesting spot to, talk about. What do you think about the bond market at the moment? Are you seeing it like investors are seeing it, like flooding into it is a good idea, or are you seeing it as this is still possibly in a downtrend?
I think rates peaked, but I need to see more. Um, I would. We have the chart in here. You go after the FOMC table, right? Like for me, that's the line in the sand for the bond market. After the table there, slide 8. So you have the pivot highs from last summer, and then the pivot lows, and 30-year, the 10-year. For the 2-year fell more, like on a short-term basis, 3-day rate of change, 4 or 5-day rate of change, last week than it has since 1987, right? Since Black Monday. So the short end already moving. I got to see the 10-year breakdown. And if you were to zoom out on a chart of 30-year, you got the 2018 highs coming right in around the same level where we have this support drawn. If these levels break, then I think, sure, you can call it. That was it. Rates peaked. You got to be buying bonds and positioning yourself for a falling rate environment, right? The playbook has been the opposite for the past few years. So I'm ready to do that, but this is really, I need to see these charts break first.
Yeah, I mean, for me, there's a couple things, and I believe that the new trend will be. I am long bonds for once. It's been a long time since I've been a bond bull, but I've been on the long side of the bonds for a little bit now.
Me
Um,
too.
I do think that gold is also a really great trade right now. Whereas we talked about earlier, like people look at gold and they're like, it should go with inflation or it shouldn't go. It's really one, it has a safe haven demand. Absolutely. It has a safe haven demand. And then two is gold, really goes with yields. As yields are dropping, gold really tends to rise. And that doesn't mean, gold is kind of the thing that rings a dinner bell for inflation. It isn't exactly an inflation hedge, but it can run up in a crazy degree and then basically tell you that the rest of the assets in the commodity complex are going to start moving up at some point soon. Usually they don't go hand in hand. Usually gold goes first, gold flattens out, and then everything starts to catch up to it, especially things like oil. So kind of looking at it right now, I'm going, okay, well, the easy trade at the moment, and there is no easy trade, but the trades that seem to be highest probability are things like owning bonds basically across the curve. The long end being the easiest one, but across the curve I like the short end as well at the moment, 2-year to 5-year as well. And then gold being another good trade, like that's a good trade, high probability of working out. And then we're kind of moving into, are we, with banks kind of looking like they're under pressure, and that's because as this starts to spread back out, banks are going to do good the second it starts to happen. Usually that's a little bit later in the cycle. So I think the place to be and seeing relative strength is all in consumer discretionary. It's also in communications, which is basically just Google. If you look at the XLC, and then also in the XLK, and then the Nasdaq. So basically everything tech related is showing relative strength, and we're kind of in the part of the cycle that things start moving into tech. But it's a very hard sell that stocks are going to be great right now. Like
I think just like you mentioned with gold, kind of being an interest rate story, all of the things that are working right now are an interest rate story, in my opinion. And I think the stock market and Bitcoin, right, or crypto are in a way telling us where rates are headed. So the reason we have overlaid bonds with Bitcoin and big tech here is because they look very similar, all carving out these nice bases, nice reversal patterns. Looks like they're trying at least to enter a new markup phase or a uptrend here. I think all these trades work at the same time for the same reason, and that's interest rates. I think you can throw gold into the same category.
Yes, absolutely. And you got, so for me, gold, silver, platinum, same category, same trends, look really good, very similar to these, even a little bit stronger than some. Bitcoin really telling, like I always tell people, I look at Bitcoin a lot to really understand what liquidity looks like, what risk appetite looks like. And so Bitcoin is kind of saying, Bitcoin's been saying it longer than everything else right now, that things are moving up. You got this bank panic and all these things kind of going on, and Bitcoin's just rallying, trying to run up as much as it can in the middle of all of it while everybody's panicking. Somebody is buying Bitcoin. People are buying Bitcoin. There is money out there. There's risk appetite out there, because that's the first thing to really sell off when there's real trouble. If there is real trouble, I promise that Bitcoin doesn't look like that. So Bitcoin is kind of saying like, hey, maybe this is earlier in the cycle than people think. Like maybe we did have a bear market. Maybe we did sell off. Now, once again, that's a prediction, not here to make predictions. Saying what I'm seeing on the charts is maybe we did see some sort of a bear market. Maybe that we started to carve out the bottom, which is pretty normal. Maybe we bottomed in October, which is very normal. October bottoms, especially in that type of year and that type of presidential cycle, and years ending in 2, and every weird cycle thing you could ever think of. Like the October bottoms do happen. And so maybe it's a situation where, as everybody's still panicking and as everybody, because look at something as simple as Bitcoin. When you look at that chart, you see those huge red candles at the very bottom on Bitcoin. That was the end of Bitcoin, the end of crypto, the FTX story, the crypto banks are all blowing up, FTX, BlockFi, all of them are just shutting down shop at the moment. Funds taken away. People who invested too heavily in these things are getting screwed. I heard Shaq's getting sued. Like all of these things are kind of all happening. And that was the bottom. So I kind of could see a similar situation where this big bank panic and all the fear that's out there, like while it might still be this shift where banks aren't doing as well, because banks did have relative strength for a while, that now the shift might be into these other assets and these other areas that have been beaten up. Because a lot of the time for me, even though I'm not a fundamental guy as much as anything else, well, mainly stock fundamentals, but I do look at fundamentals, just not stock fundamentals as much. I see that tech got to a point where it is beaten up so much that it started to look a little bit attractive, and then you have semiconductors leading the way. And no matter what, I hear every single, fundamental person talking about all the fundamentals behind semiconductors and how they're stupid to invest in right now because of blank and blank. The end of discussion for me on that is that they're just going up. I can't argue with that. I can't say that they're worthless if they're going up every day. So you have this major relative strength in another risky area. You have this major relative strength in Bitcoin. You have major relative strength in bonds. It very much looks like a early phase of a new cycle where bonds started to bottom at a certain point. These tech stocks start to follow, and Bitcoin's just decided it's in the mix as well now. So it's like, okay, well, I really can't argue the price action at the moment. I can't argue it away and just say, hey, this is obviously the end and we're going into another bear market. It's telling me a different story, and I always have to be open to that different story if the price is telling me something.
I mean, could it be so simple as these assets do terribly when interest rates are rising, and we just watched, the Fed hike rates faster than any time in history? Now maybe that's over and they're pricing it in. If you look at Bitcoin breaking out of this reversal pattern, if you look at tech, especially on a relative basis, making new, 52-week highs, it looks incredible. Especially these mega cap tech companies, they look great. Listen, I'm with you when it comes to the risk appetite. It's not defensive. Well, I think there's an element of safety trade and quality in big tech.
Yes. Yeah.
Your Microsofts, your Apples, it's not the whole story, right? Those aren't the only names working, right? It's like you said, look at NVIDIA. It looks better than any of them right now. So I think it's risk on. Bitcoin is never risk off. A lot of stuff that I'm hearing lately is, Bitcoin's rallying because it's the death of the traditional financial system and banks are blowing up and there's no confidence in, the financial sector. That's not it. in my opinion, at all. It has nothing to do with it. This is
I've
very
never
much
seen a rally for those reasons historically, but you know what? The one thing I do try to say about Bitcoin when I do talk about it is to always say is a very new asset. Certain things I've been able to back test back to 1900. Bitcoin is not one of those, so I don't know exactly, but I know historically it's never been a safe haven. It's never been a safe haven. It's never traded like bonds or gold. It's yes, at certain times it's gone up together, but that's been more of a coincidence, in my opinion, than anything else. Bitcoin is really a risk, the heart of risk on, just like the big tech companies of today that are almost the quality companies like we're talking about right now were the risk on companies back in the 90s. So I could see this being Bitcoin's telling part of this story. And yes, people are going to come out of the woodwork and saying all those things. And also the Fed really over everything else, and you would understand this probably more than I even do. I feel like the Fed more than anything else is always going to be very cognizant of going, hey, people are losing faith in the dollar. People are losing faith in the financial system. People don't want to put their money into banks or in fear of it. I mean, I have friends who heard about this happen and they started pulling money out of the banks and they're all freaking out about it. So I can't see them, just continuing to go, okay, that didn't mean anything. We're going to just continue hiking. Inflation is so important that we're going to, destroy the financial system, like it doesn't make sense unless they're really trying to, but I don't think that's the case. I think it's the Fed gets behind the curve. They got behind the curve a lot on this one from the way down. Inflation was transitory, then inflation became a problem. Now they did so much, it almost, prices are not where they were, but they're stable. That's supposedly their model. So I see the stability in prices starting to come back. I see that a lot of the credit tightening hasn't really hit the market completely yet. And I could see the scenario where the Fed funds rate is saying, if probabilities of cuts even in the year could happen. Now, I'm not sure about that by any means, but I could see, a pause certainly happening pretty soon. I could see them going, okay, we've done enough. We've killed inflation. It's now dead and gone. And move back on with that cycle. And honestly, that would be enough with the money they're pumping in. The balance sheet going up and so on to create a rally. And not to mention the market's always forward looking. So if there is something that's going to happen in the future, the market's going to start pricing in that, and that can make other things start driving higher. And the curve, honestly, is going to start to move its way because it just has to. They can't continue to put so much pressure on the financial system and expect it to run well. It's impossible.
The curve should, like the 2-10 spread, should continue to move higher if and when or as rates come down, right? As the Fed moves rates lower. I think, the bigger question becomes, how bad is this coming recession going to be, right? I think, sure, the Fed at least won the battle for now. Yesterday, after the decision, the market was pricing in the first cut by July and then an additional 2 by December. So I think the question starts to become, okay, if rates peaked, fine, but do they go sideways now? Like Powell is saying, right? He's saying we're just going to leave it here for a while. And you can look at like the terminal rate for kind of a read on that. It hasn't budged too much. But the market's starting to say, no, they're going to have to start cutting soon. What does that look like? Is it something where they're cutting because things are so bad? In which case risk assets are probably under pressure, or are they just cutting in some sort of orderly fashion and, liquidity is coming back into the market and stocks are having a great time? Have to see.
And normally that's never the case. Normally the case is there's something bad that's happening. And my opinion on it, and even the tech trade, the Bitcoin trade, the gold trade, is in the moment and over the next, few months, that's where I'm thinking I should be, at the moment. Can't speak for anybody else. That's where I'm thinking I should be: bonds, gold, possibly tech. But I could absolutely see something happening where, something big happens, because this put a lot of pressure on the system. As you said earlier, that's not the end of things. I don't think so either. Yeah, I think they're gonna work real hard to backstop everything this time, and maybe, I'm wrong, and they come in and they finally create this soft landing that they've always tried to do and never really figured out. But at the moment, as traders, like, we have to be open, because for me, what I see happening is we're in this type of environment right now, and bonds do well, gold does well, and maybe tech does well. Something possibly happens after this, because this is normal Fed action. Maybe some sort of crisis. Fed drops rates. Inflation gets back out of control again. And then they have to come in again. And that's kind of more what I'm thinking, rather than thinking like, hey, we're out of the woods, everything's great. I'm more thinking, hey, for now, things look okay, but we have to really be open to that there's something, there's a black swan building out there, and I don't know exactly what it is.
Oh, this is why I love talking to you. Go to chart 15. I couldn't agree more. I tweeted this one out the other day, and again, chart porn, sorry. We're just pretty good at it by now. What you're talking about, the Fed hasn't been able to get out of these situations in the past without a crisis, right? So this is the 2's10 spread, and it's not when we get inverted that you see the market collapse. It's when it turns, bottoms, and starts moving higher, which is typically when the Fed's already started acting, right? Or paused in these cases. So it's very easy to look at this chart and say, okay, stocks are going to collapse. Again, it's happened the last 3 times we've been here and turned higher. But when you look at the facts and circumstances that we have, right, and the information, the data that I have available to me right now, and we're never going to make a call like this. This is crazy, unless price is confirming it. We're not seeing it. Like I said, tech stocks and Bitcoin are making new, 6-9 month highs?
Yeah.
Look great. Until the market starts to move in this direction and suggest that this type of an outcome is even possible, there's nothing I see out there to say, okay, stocks are going to draw down 40% from here in the next year or two. It's nothing. In fact, it's the opposite. Things still look constructive and okay. So maybe something happens. Maybe it's this regional bank thing. Maybe, this is the Kindle that starts burning some fire that moves into the tech sector and God knows what else, but we haven't seen it yet. And prices aren't telling us that at all. These risk on groups, whether it's discretionary or tech stocks, I was looking at home builders just before we got on. I'm like, why do home builders look so good? I see real estate prices. My realtor buddies are telling me one thing, and I'm like, look at Toll Brothers. It looks great. So, strange world we live in. Let's follow price and see. Even this week, copper, crude oil, they're trying to, claw back some of the recent losses. Doesn't seem like the end of the world out there. And the other part too is the dollar looks like it's just moving steadily lower these days. We were at the top of the list of people out here pounding the table about the dollar peaking and rolling over last year and what that meant for risk assets. If the dollar continues lower, that's a tailwind typically for risk assets. So from an intermarket standpoint, there's a lot going on that could suggest different things right now.
Yeah, I mean, for me, I really see it as we have a bullish bias at the moment right now. And I could see, for example, I think when people look at these charts, for example, they always go straight to, okay, well, all right, well, it's going up and crash, and it's going up and crash. But really, it starts to move up, and there's usually and everybody who's studied inversions knows this. After the inversion, there's usually a big rally, not long, but 6 months or so. A lot of money was made in 2019 right here. That was I remember there was August, it was very choppy. We bounced out of it, came back a little bit in September, and then just rallied straight through till basically the COVID crash. When it started, I think it was January where the market topped. And so, for me, maybe we're in that type of scenario where there is something bad coming, but you can't, like, what do you, as a trader, like, you could be a part of the rally, wait for price action to tell you to get the hell out of the rally. Or like as a trend trader, for me, there's going to be a signal of a trend change and I will be out of that rally. Or sit out completely and know that there will be a crash. That's another idea, but once again, you never know for certain that there will be a crash. This is 3 data points. In a back test, if I told you, I have my models, and if I went to a fund and I said my models have 3 data points, for my trend following models, they would laugh me out of the building.
Right.
And that's what everybody kind of looks at, these 3 different things and goes, okay, this is exactly what's going to happen. And really, this is a possibility, be open to it, but the market is in a much different place than those 3 times. But once again, like, you have to always keep in mind, is this time different? Like, I know I don't want to get caught in that feeling. So I'm always open to, that's a possibility, that's a possibility. But right now, as a trader, there's money to be made. So let's do that. Let's do the right. That's really the thing about trading, is just doing the right thing every day, the right move every time. If you're looking at it now, and there's long signals in currency, like most developed countries' currencies against the dollar. There's long signal in most developed countries' bonds. There's long signals in gold. There's long signals in silver, platinum, tech, semiconductors, whatever. There's a bunch of long signals in these things. So right now, take the right signals, do the right thing. When there changes to sell those signals, that's when, and most of the time, it's the other thing most people don't understand about technical analysis. Most of the time, I'm not going to get a crash when I'm in I've actually never have gotten a crash when I'm in an uptrend signal. It's never happened. A crashes happen when you start to change signals. For example, this is a huge run here. There's no way in hell, I wouldn't have got a signal. The signals came around here. There was a big top in 2000, and that breakdown signal got out way before all that stuff and went short.
What do you use for your uptrend signal?
So there's a bunch of different signals, but like, let's just look at a basic signal. For example, I had a video that I just posted, and we used Meb Faber's model just as an idea of relative strength, and just a very basic signal of monthly, a 10-day moving average on a monthly chart. That's the most basic signal you can get with only looking at the charts once a month. That signal still gets you out of every single crash. Every single crash scenario, you are still out of every single crash with a simple signal like that, looking at it once a month.
Amazing.
Something different, another one that does it is 50-day lows. If you just have a 50-day low on there, that absolutely gets you out at that point as well. And once again, these are not perfect signals. There would probably be a chop here. You'd probably get out at this crash that happened in the LTCM crisis. That would have got you back in and then back out again. So you're not going to be perfect through everything, but once again, you're avoiding this. That's what you're really trying to avoid by these big long-term trend following signals. You're avoiding these crashes. So I think the important thing to really understand about technical analysis is, I don't really understand another way that is a perfect way of getting out of risk. Same thing as, if there's no trend following system that would tell you to start buying any of this, like buy this. I mean, hell, even the 200-day moving average, we didn't even make it over that in any of these. So, it's not going to tell you to buy these things at any point here. It will not catch this perfect bottom, but it's going to start to buy up here again. So if we're looking at those type of systems and understanding that, okay, our goal isn't to catch these things all perfectly. Our goal is to catch the meat in the middle. And so as that's important, you have to be involved in this part of that rally. Could this rally be the big one and restart a whole bull market? Absolutely. That's completely possible. Is it a rally that's going to turn in 6 months and be a crash? Absolutely. That's completely possible. So playing both sides of that by having, simple systems, simple signals, even don't even use them systematically. Just look at a chart and go, okay, well, you know what? I'm a stock trader. Let's say you're a stock trader and you only trade stocks. I'm going to look at the S&P 500. I'm only going to buy the long signals and things I like when it's above the 10-day moving average on a monthly chart. That's it.
Yeah.
Something as simple as that will save you tons of money, stress, keep you away from catching falling knives. That these are very important parts of technical analysis.
Breath thrusts too is a big one, right? If it's the beginning or the end of a cycle, you should be able to really look to your breath data and be able to identify those spots. In terms of recently, with the rally off of the October lows last year, we did have some very bullish breath signals, but I think we still need to see more. I want to see it kind of move through to longer term new high indicators. We never got anything from like a 52-week new high or new high low indicator. So from a breadth standpoint, it's not, we've had very constructive rotation, right? So think about it. Remember just late last year or even early this year when everybody was talking about the Dow, and the Dow was the index to be in?
Leading everything. Yeah, I remember because I kept making jokes because it was the first time I had long signals in the Dow over everything
Right.
else.
Yeah. We're used to it lagging, right? And now it's back to lagging, and the Nasdaq is the place to be again. So just like in that way, we saw the value stuff work. We saw the materials, energies, stocks were strong, financials, and industrials. Even industrials did really well. And then they kind of passed the baton over to the growth stuff. Right? We've seen the tech and communications and discretionary really work this year. So it's been constructive rotation, but we're not seeing a buy everything type of market, like a huge breath thrust where everything's working all at the same time just quite yet. But you do tend to kind of see that just rush into everything kind of occur at the very early stages of a new uptrend. So I think we're still in the bottoming process. If you look at equities, we've been doing a lot of basing. I can see it on this chart right here. That's the S&P, right?
Yeah, so basically, I was just bringing this up because of you talking about breadth thrust, and so this is sector breadth. This is I love these charts, and you can kind of get sector breadth thrust. But what's interesting is we had tech kind of give these sector breadth thrusts very early in this year. So not a breadth thrust, but breadth looked really good in these sectors to start the year. And some of these things started to fall away a little bit. F being one of them, getting a lot weaker than everything else. So it's interesting to kind of just look at this and go, okay, well, there is still strength in certain areas. And then when we look at something like the Nasdaq has a very bad breath signal at the moment. It looks like trash, the NAAD. Now, I don't really use the Nasdaq breath signals for much because the Nasdaq being such a composed of so many different things, and this NAAD signal is not just the 100. But when you're looking at this, also like this looks really bad. This looks really
red
bad.
line. That's the Nasdaq advanced decline.
Yeah, the red line. Yep. So this looks really bad in comparison, but once again, what is really like, and I'll ask you, you can answer this. What is the main stocks in the S&P 500?
The same as the ones in the Nasdaq, right?
Yes. But the main stocks in the S&P 500, these are these huge tech names that are taking up a huge amount of the S&P 500. So it's kind of like last year when energy was leading the way. And the big question I would pose to people all the time is, can the market go down as energy is going up because energy became such a small part of the S&P 500? And the answer is yes. But the opposite of that is, can the market go down with these big tech names going up? And the answer is no. That's a no. So I could see those huge tech names coming in, and even without a major change in breadth, start to move the entire market up with it. And that being, in either way, like let's say I'm wrong and it doesn't move it up. You still would rather be in the strongest sectors if this is an uptrend rather than be in anything else.
One thing we always say, internally is like the Nasdaq is just not the stock market. It's not even close. So there's like little to no financial or energy exposure. There's like almost no materials. Nasdaq is really just a tech index, right? You got tech, discretionary, growth. It's a growth index. You're talking about the Microsoft, Apple, Google, Amazons of the world. I think they make up almost like 40% of the Nasdaq still today. So it's crazy. You want to look at what most stocks beneath the surface are doing to measure like the true health of the market, right? While it's good for the best players to score most of the points, right, on any team, it's not a bad thing for these guys to lead. You need participation from everything else. And I think we're getting it to varying degrees. Sure, it's become a mega cap market again, past month or two. But let's give small cap tech, mid cap tech, let's give them a chance. Even mid caps were showing like some really nice strength earlier in the year. Maybe we see a resurgence there. Micro caps, the Russell micro cap index looks scary right now. Challenging new 52-week lows. So like let's see kind of how this all shakes out. But I do think if we go back to the credit crunch, right, and what we're talking about with the banks breaking, I think that there's a dynamic at play there where big cap tech is going to be okay through all of this, but small cap tech might be a tough place right now. I think those companies are going to have a tough time attracting capital. It's going to be really a bootstrapped environment for a while. So you might see a dynamic where big cap tech is killing it, doing great, recognizing all these new efficiencies from AI. Right. And then small cap tech and the startup space is really struggling with dealing with the fallout of the Silicon Valley Bank stuff.
Yeah, no, I agree. And it's, there's so many different dynamics to it. But for me, I kind of, there's two things. If it stays like this, I'm still not against the market and the Nasdaq moving up at the moment. I still don't think that's impossible. I do, however, know how that's happened in the past. Now, in the past, when you have only a few stocks pulling it up and they are the big names, I'm not one to really look at individual stocks much, but I do start to look at them at those points because 2018 is the last easy example to actually bring this up. All through history, this happens all the time. You got the big names and they start to fall out. But 2018 is a recent one we could talk about easily because everybody will know the names. So when we're going up in 2018, the market was basically held up by just a few names at that point. It was one of the worst breath I've ever seen in the market while it was still kind of holding up. You had the FANGs basically holding it up, and that was it. And I remember it went like Netflix had a bad earnings report or something, and it came down. Something happened with Google, it came down a lot, and then Facebook had a one-day crash that was insane. Actually, if you look at that daily chart, there's a huge, I think it's like 20% in earnings. And then it fell even further, it continued down. And basically the market was still kind of, it looked like trash, but the market was still petering to the upside at that point, and then you had Apple just kind of, it was right after everything started moving down in the market in October. Apple had an earnings report, and then that came down. And that was kind of the last domino that fell and made that massive correction kind of happen. Yeah. So for me, what I really want to pay attention to at this moment is the market going to stay this thin? If it is this thin, I need to pay attention to those names, especially like if you look at, if you're, let's say you're a ETF investor, and if you're just trading the XLK, that's basically two names. You're talking about Microsoft and Apple being most of that ETF. So you have to really pay attention to those names, understand what's dragging it up. And as these things start to fall off one by one, be really open to the fact that this could change trends very easily. It's like you said, we want to see participation. That's why we like to use breadth charts. I'm more constructive on a market that has better breadth than this. But once again, the price action is a price action. Mega caps are such a large part of the market now that it can hold it up. And I think it's also a thing of people running, as you said earlier, to quality. People in the United States, we have so many different industries, obviously, but the big ones that are going to be the ones that people look for, to almost the blue chip companies these days, are Apple, Microsoft, and these big tech names. So I can see right now people are kind of flooding into those. We're seeing where those are going to end up at the moment. So keep watching the tech space to kind of really understand market direction. Keep watching bonds to kind of really understand. Maybe that's, I think that goes two ways. If the market goes to shit, bonds are still probably a great trade. If the market doesn't do too well either, gold is probably still a good trade. The only thing that is in this thesis that is kind of the lower probability of working, even though I still like it, is the tech trade. But once again, it looks really good right now. And if we start to see breadth and other sectors start to come with it, I'll be really happy. I'd be really constructive on the market.
One thing that's important, what I'll say about your comments on breadth is the market's thin. Yes, right. It's not a terrible thing for big caps or mega cap stocks to lead the way, right? You don't want to just turn bearish just because of that. You want to give the rest of the market time to catch up. So if you want to remove the cap weighted impact that you're talking about on something like XLK, look at RYT, the Invesco equal weight ETF, right? And if you do, it's not the end of the world. These stocks aren't crashing, right? When you remove the Microsoft and the Apple from the equation, but they're well off of their February highs, right? So the question then becomes, does RYT, does equal weight tech break down and start making new lows here? Or does it play catch up and start making new highs and take out those year-to-date highs just like XLK just did, right? So while breadth is important, you totally want to consider it, and we want to see that participation down the cap scale and away from the mega caps. You also don't want to panic just because mega caps are leading. Sure, when mega caps lead, these charts are going to look this way, but it doesn't mean the rest of the market won't pick up the pace and start to follow. In fact, that's very common to see the mega caps lead and then the rest pick up the pace and follow, right? But it can go in both ways. So it's just something to monitor. And totally, if this is going to be a new bull market or a new uptrend like we talk about, you are going to see RYT catch up, make new year-to-date highs, right? And all these equal weight ETFs start looking more like the cap-weighted ones. It's just kind of like a timing thing right now. So
that's a great point. That just to add on, yeah, that's the inverse of what I'm saying, and that can work both ways, either way, completely. And at the moment, I'm obviously, if I'm interested in tech, I'm obviously thinking this way is probably the most possible at the moment. But being open to both of the ways makes sense at the moment. This is interesting too. You probably already know this, but looking at the equal weight S&P, it was interesting that it made a 150-day high.
yeah,
And the S&P didn't. So, we did have a lot of participation earlier. So that also should be brought up. There was a lot of participation early in this rally. We didn't have the participation from the big cap names. Now we're seeing the participation from the big cap names, made a higher high. I would love to see this also make another 150-day high, and then it would be really, I'd be really, really bullish that we could get back to those old highs again. So it's really interesting.
those August highs are so important, right? So you're showing the RSP actually took out the August highs back in February, and that's such a big level for me. Nasdaq, that's now the next, if we're taking out these February highs, we got to look at the August highs. So I think there's an equal weight Nasdaq ETF too, QQEW.
Yeah.
Almost did it. Might have even. No, close.
Yeah.
Close.
Yeah.
Yeah, you're right. And that's a great point. So like give the market time, right? It's not like we've been in this environment where it's nasty internals all year. No. The way we kicked off the year was incredibly constructive, right? Things were really working beneath the surface. So now just maybe since February, it's been a mega cap environment. Let's see what Q2 has to bring.
Yeah, absolutely. All right, Steven. So it's about 2. I'll let you go. This has been great. I really appreciate you coming on, man. It's always a blast to kind of have these conversations and really get to dive into the charts and just see what's going on, because there's when we go out in the normal media and the normal world, we don't really get to really dissect what's happening. even if you do go on a media thing, they want you to basically tell them, what are you picking today and what looks awesome and what does it, that's not trading. Trading is really trying to dissect a thesis, understanding the thesis, and then figuring out how you're going to play that thesis, figuring out what signals you have and what the risk management is between it. And that's why when we're talking about scenarios, and like you said earlier, that a good trader can go every which direction. And you might seem wishy-washy, but that's what you have to do. So, being able to kind of come in and go, well, this is the scenario, this is what I'm thinking, but also creating the thesis against what we're thinking, that's good trading.
Be nimble, right? Know where you're right and know where you're wrong, right? Know where you're out. And also just be always so aware of the fact that the market knows best.
Mhm.
And never put yourself in a position where you're holding on to a thesis and you're going to impose your will on the market. That's the easiest way to get hurt. Listen to the message of the market and adapt and be flexible. And you'll be okay if you do that, right?
Awesome. Well, this has been great. Everybody, thanks Steve so much for coming on. It's been an absolute blast for me as well. So hope you guys have a good week of trading and a good weekend.
This is always fun. Thanks for having me again, Jason.
Of course.